Okay, welcome to part 2 of Income from Other Sources revision. Welcome to Jekesha classes. In part 1, we discuss section 56.1 and 56.2, which incomes will be taxable under the head Income from Other Sources. We mainly discuss about gift transaction, which was very important. Now in part 2, we are going to discuss about other incomes taxable under the head Income from Other Sources. Apart from other incomes, we will mainly be discussing about deemed dividend under section 2 clause 22, and we will also discuss about section 57 allowable expenditure under this head, 58 expenses not allowed under this head, and 59, which is one liner thing which is unimportant, deemed profit. Here we will mainly be discussing about dividend, and we will discuss about other incomes taxable under IFOS. Other incomes which are not specifically covered but are taxable under the other source. But remember, fundamental thing is that any income, this is the residuary head of income, so only those incomes will come under this head which are not taxable under other heads. Which are such other incomes taxable under this head provided not taxable under other head? First income is interest on bank FD, company FD, interest on loan given to somebody. What we had discussed at the beginning of the chapter in 56 subsection 2 was interest on securities, that is debenture interest, bond interest, etc. This is interest other than on security, interest on loan, FD, etc. provided not taxable under the head PGBP. Second is royalty income, for example royalty from writing books, royalty for production of a movie, provided royalty income is not taxable under the head PGBP. TDS will still continue by the payer under section 194J. Now three more items, next three items are payments received by director from his company, employer company. Even if he is an employee, these three items are not taxable under the salary. Number one, director's sitting fees, which is also called as directorship fees. What is directorship fees? Directorship fees is an extra amount paid by company to the director for attending board of directors meeting. For every meeting of board of directors, director will get 5,000, 10,000 extra. That income is not taxable under the head salary. Next is underwriting commission received by director for underwriting shares of employer company. And next is commission received by director for standing as a guarantor for the loan taken by employer company. In these three situations, TDS will, in all three of them, TDS will be under section 194J. If you recollect TDS chapter, TDS will be at the rate of 10% without any threshold limit. Next is letting out of a vacant plot of land and rent from ground rent. Ground rent and rent for vacant plot of land both are same only. The only difference is of size. Plot of land is smaller in size, ground is bigger in size. If there is a house property or a building also on the land, then income will go, rental income will go under the head house property, IFHP. But if there is no house, only plot of land, then interest or rent from that land will go either under the head PGBP if this is a regular activity of the assessee, else it will go under the head other source. Agricultural income from land situated outside India will go under the head IFOS. Next is family pension, on which questions have never come, but there is a small amendment out here with regards to family pension. Till the time employee is alive, he receives salary if he is working. After retirement, he receives pension. Salary as well as pension both are taxable under the head salary. But after the employee dies, pension continues in the hands of family members. His widow will receive pension, which is called family pension. Due to lack of employer-employee relationship between the widow of the deceased employee and the ex-employer, there is no employer-employee relationship. Therefore, family pension will be taxable under the IFOS, cannot be taxed under the salary. From salary, there is something called standard deduction allowable, 50,000 or 75,000 under new tax regime. Same way here also from family pension, some standard deduction is allowable under section 57 clause 2A. But family pension, the standard deduction from family pension will be not flat 50,000 or 75,000. It will be either 1/3 of the family pension or rupees 15,000. 1/3 of family pension of 15,000. Instead of 15,000, limit is slightly hiked up to 25,000 in case if family members opt for new tax regime. Income from subletting of a house property. Subletting as in tenant also lets it out further. So landlord and tenant, apart from that, one more party is involved, subtenant. For example, Mr. X is the owner of the house. He lets it out to Mr. Y. Mr. Y will be tenant. Mr. X is the owner. However, this tenant also lets it out to somebody, then it is called subletting. He sublets it to Mr. Z. Mr. Z will be subtenant. Owner or landlord, tenant and subtenant. Three people are involved. Now here, what happens is owner receives 4 lakh rupees, that will be taxable under the head IFHP. A tenant, he pays 4 lakhs to owner, but he collects 6 lakhs from the subtenant. He receives 2 lakh rupees difference in between. That 2 lakh will be taxable under other source. Cannot be taxed under house property head, because the reason, in order to be taxed under house property, assessee person earning the income should be owner. Tenant is not the owner, therefore cannot be taxed under IFHP. Next is salary received by MP, MLA, MLC, unimportant, never comes in exam. Income from any investment, any kind of small investment. Casual and non-recovery incomes other than capital gain. Casual incomes means something which is once in a while, which is non-recurring. Repetition is not there. Other than capital gain. Like for example, I went to Dubai, I bought iPhone 16 and I sold it in India with 10,000 profit margin. I do not intend to repeat it again, and I had not purchased for my purpose. I did not use it, straight away sold it off. Ideally, income should go under the head PGBP or capital gain. Will not go under the head PGBP because this is not my business, and will not go under the head capital gain because mobile is not a capital asset for me. Therefore, IFOS. Any income received by person who is the owner of the race, income from owning and maintaining a race horse. Only horse, no other animal. For other animal also, income will be taxed under this head, but income from owning and maintaining race horse always under IFOS. Income from owning and maintaining other animals will go either under the head PGBP or under IFOS, depending upon what is the business activity of the assessee. But if it is a horse, animal concern is a horse, then compulsorily IFOS. If animal is other than horse, then either PGBP or IFOS. If the animal is horse but is not a race horse, it's an ordinary horse, then again two options, PGBP or IFOS, depending upon what is the regular activity. During my time, there was one horse called Badal in Bollywood films. Somebody who used to let out that white color big horse for movies, for a production of Hindi movies. Then in such situation, that was his business activity. Then letting out of a normal horse will be under the head PGBP. Interest on income tax refund or any other government refund. Remember, principal amount of income tax refund is not an income. Only interest on that income tax refund or wealth tax refund, etc. is the income. Will be taxable under the head IFOS. Okay, principal amount is not taxable. 16 honorarium. This comes in the exam sometimes. Inter CA it used to come regularly. Final CA it never comes. Honorarium means honorary services, amount received for providing honorary service. Honorary service means free service. So social work kind of a thing. As a teacher, I have provided my honorary lectures at various places. But then I am spending my time, so other party, the students organization or the hostel people, they sometimes pay something worth 400-500 rupees, bouquet or pen, etc. That will be received from college, university, etc. will be chargeable to tax if it is disclosed. Dividend, including deemed dividend under section 222. Now what happens is, there are two types of dividend, real dividend and deemed dividend. This part of dividend or deemed dividend is an important part. Part 1 of this revision lecture, we discuss gift transaction, and part 2 focuses on dividend. These are the things which come in the final CA exams. What is dividend? Dividend, you know, we receive from shares. Whether received from equity shares or preference shares, whether received on equity dividend or preference dividend, maybe final dividend or interim dividend, maybe from public company or private company, all such dividends are taxable under their IFOS. And dividend is mandatory. Dividends are always taxable under their IFOS. So that we already discussed now. We had a point, answer yes, last session we did in part 1. But part 1 we talked about real dividend. Here we are talking about deemed dividend. Deemed dividend, there are 5 types of deemed dividend. One more newly introduced, from 1st October 2024, section 2 clause 22F. So up till now, 2 clause 22 subclause A, B, C, D, E were there, 5 were there. 6th one is newly introduced from 1st October 2024. Question expected on this in the upcoming attempt. So dividend can be final or interim or actual or deemed or preference or equity, but here we are going to discuss about actual and deemed. So deemed dividend, 5 plus 1, 6 types of deemed dividend, starting with 222A. 222A, any kind of distribution of assets, any distribution of assets by the company to the shareholder, any distribution which releases the assets of the company, then that will be deemed as dividend. However, it will be deemed as dividend to the extent of accumulated profits of the company, only to the extent of accumulated profits of the company. Generally, this never happens in real life, but by chance if company has distributed, mainly private company, sometimes what happens is private company which is family owned company, so director shareholders are all same only 2-3 people are shareholders and they only manage the company, they are directors also. So sometimes what they do, they purchase the asset in the name of company and they start using it for personal purpose. Then in such situation, when inquiry comes, they say, okay, company has given it to us, we are directors. So in such situation, ownership changes when that is release of all or any part of the assets of the company to its shareholder will be deemed as dividend, but to the extent of accumulated profits of the company, not entirely. Unimportant, 222B, that is, this is important from exam perspective. Company is giving bonus, but giving bonus is, it's okay, bonus is not taxable in the hands of shareholder. Answer right. If bonus shares are given to equity shareholders, then it is not taxable. But if bonus shares are given to preference shareholders, then that will be deemed as dividend under section 2 clause 22 subclause B. Bonus shares to preference shareholder and distribution of debentures, debenture stock, bonds, etc. to any shareholder. Bonus shares to preference shareholder or distribution of debenture, deposit certificate, FD to any shareholder, then that will be dividend. First part is distributed to equity shareholder or preference shareholder, but bonus if declared to preference shareholder, then it will be deemed as dividend, but naturally to the extent of accumulated profits of the company. Bonus shares to preference to the extent of accumulated profits of the company. However, mind you, bonus shares given to equity shareholder will not be deemed as dividend. And how to find out the value of these things? So answer, as far as valuation is concerned, debentures or FD certificates are given, then market value to be taken into account, the rate at which debentures are traded in the stock market or debentures are quoted. However, if there is no quotation available, there is no trading, not listed, then will be value according to accepted principles of valuation. In exam, they will give you the value. If question comes, you just need to remember that bonus shares to equity shareholders is not considered as dividend, but preference shares it is considered as deemed dividend. So A, B, C, A and B, whatever we have discussed, both the places to the extent of accumulated profits of the company. Same is the story under 222C, distribution by company upon liquidation. Distribution upon liquidation. Now, all three A, B, C, subclause A, subclause B, subclause C are all three applicable to public company, private company both. Any distribution made by company to the shareholder upon its liquidation to the extent of accumulated profits of the company. So subclause A, B, C, whatever we discuss, all three apply to private company, public company both, but applied to the extent of accumulated profits of the company, not entirely. Immediately before, accumulated profits as on which date? As on the date of liquidation, or simply immediately before liquidation will be deemed as dividend. This liquidation related part, we had a discussion in capital gain chapter also. If as a result of liquidation, you are the shareholder, you receive from the company some asset is received, then you pick up FMV and you receive money, then the money has its own monetary value. Say asset FMV is 13 lakhs and you receive check of 12 lakh, total 25 lakhs is received. So step number 1, you take the total of these two. Step number 2, you divide it into two parts. How much will be deemed as dividend under 222C to the extent of accumulated profits. And thereafter, we discussed this with the help of an example in revision of capital gain chapter. In case you have not watched that video, please immediately log in and download it or go and watch it. 222D, distribution on reduction of capital. Any distribution which results into reduction of the capital to the extent of accumulated profits, whether given by public company or private company. So 222 ABCD, common points, 2 points are common. Concept applies to public, private, both the companies, and it is applicable to the tune of accumulated profits of the company will be deemed as dividend. Any distribution to shareholder which results into reduction of capital. Recently, I came across one situation where one Indian company is holding shares in foreign company, and you are the shareholder of this company, you are Mr. X. Company had issued you shares at 100 rupee face value, 100 rupee. Now this company, out of your 100 rupee, they invested 20 rupee in this foreign company. Now what company wants to do? Company wants to sell off the shares of this foreign company. Indian company wants to sell the shares of foreign company. Instead of selling the shares, they gave away the shares to you, and at the same time they reduce the capital. Capital is reduced to 80 rupees. So your shares of Indian company value came down to 80 rupees, plus you are being provided foreign company shares were 20. Your portfolio remains same, 100 rupee, but your capital investment in the company got reduced to 80 rupees. So any payment, however, this exception is no more applicable. For this was exception about buyback. Now buyback will also be regarded as deemed dividend as per 222F newly introduced, which we will discuss. 222E, okay, now 222E is slightly different than other points. In all the other earlier situation, concept was applicable to public, private, both the companies, and were applicable to the tune of accumulated profits of the company. However, 222E is applicable to private company only, that is company which is closely held company, private company. Here company is not actually distributing assets or something. Here company is giving loan to the shareholder. However, this point is applicable to 222E only if shareholder is holding substantial interest, that is holding 10% or more than 10% shares of the company, either singly in his own name or jointly with other people. Number one, company should be private company. Number two, shareholder should be holding 10% or more, either on his own motion or along with his relative. And company gives him loan, then the entire loan amount, whether the loan is with interest or without charging interest, loan amount will be deemed to be dividend in the hands of shareholder to the extent of accumulated profits. Private company, that is company in which public are not substantially interested, gives loan to the shareholder who beneficially owns 10% or more of equity capital of the company, either on his own or along with other relatives, will be deemed as dividend, but to the extent of accumulated profit. So to the extent of accumulated profit is common factor in all the deemed dividends in 222A till 222E. Only different here is this 222E applies only to private company. Okay, let's try to understand with the help of an example. There is one private company which gives loan to shareholder. Shareholder should be holding beneficially 10% or more of voting rights. Normally substantial interest holding means 20% or more, and in transfer pricing chapter it is 26% or more for becoming associated enterprise, but here it is 10% or more singly or jointly with relative. Then as per 222E, that loan amount will be divided into two parts. How much is to the tune of accumulated profits of the company, and balance will be considered as a genuine loan if at all. Okay, for example, accumulated profits of the company are 100 lakh and company has given him loan of 110 lakh. So first 100 lakh to the tune of accumulated profit will be deemed as dividend, and balance 10 lakh rupee will be deemed to be genuine loan, whether interest is charged or not charged. However, this has some 3-4 exceptions which we will be discussing one by one. So to the extent of accumulated profits of the company, it will be deemed as dividend, subject to some exceptions. 3 exceptions I have covered here, 1 exception in the next slide. First slide, if giving a loan is a substantial part of the activity of the company. Giving loan is a main activity or substantial activity of the company. Company is Annapuram Gold Loan, company is an NBFC, and company, this is what is the main activity of the company. Company is in the business of giving loan, secured or unsecured. And the way company gives loan to outsiders, same way company gave loan to some shareholder. What is wrong in that? Then it will not be deemed as dividend because this is an official exception covered in 222E itself. Then loan is given in the regular course of business. Now many people and many teachers also don't understand what is giving loan in the regular course of business. So understand, company is into manufacturing of some product, and that for manufacturing that product, company requires some raw material, and that raw material is manufactured by one of the shareholder, Mr. P. Mr. P manufactures some product. Whatever is the final goods, final product for Mr. P, that becomes raw material for company. Simply, shareholder holding 10% or more is supplying raw material to the company. So company had to give him some advance. He regularly supplies raw material. Company gave him advance for purchase of raw material. Company gave him 50 lakh rupees as advance. This is called advance given in the regular course of business. In the regular course of business of the company. Company's regular course of business is to purchase raw material. So to purchase raw material, if loan is given, then it will be second exception. It will not be deemed as dividend in the hands of shareholder. Or loan is given by company for any benefit or favor in return. This is based on case law. This is not given in the act. Based on some case law. Whereby what happened was, shareholder had given some benefit to the company. Shareholder had given some benefit. Shareholder Mr. X holding 40% shares of the company. He was owning one extra land building which was lying idle. The company wanted some loan, but company's financials were not strong enough to get the loan. So what company did? Company requested Mr. X that bank is demanding for some security for pledging. You do one thing, company requested Mr. X that you give your land building for mortgage, and he agreed. So he gave it as a mortgage. Property worth 80 crore rupees is mortgage, so that bank will give loan to company. Bank gave them loan of 50 crore rupees. Okay, now one fine day, Mr. X was desperately in need of funds, and he has this property, but his property is mortgaged with the bank for giving loan to the company. Now he is in need of some 2 crore rupees. So he requested company to repay back this 50 crore loan so that bank will release this property so that he can sell this property and manage 2 crore rupees requirement. So company asked him that, sir, how much do you need? He said, I am in need of only 2 crore rupees. So company said, sir, because of your 2 crore rupees of small amount, if we try to repay, it will not be possible because 50 crore is not lying idle. 50 crore loan is entirely used as a working capital. It is blocked. It will take some time to release, or it will take a lot of time to repay full 50 crore. So company gave him an option that, sir, you are in need of 2 crore rupees only, no? So we will give you loan of 2 crore rupees. On paper, we will show it as a loan. In such situation, company has given this loan to shareholder in favor of this facility from the shareholder and not without any consideration. Therefore, this 2 crore will not be deemed as dividend as per one of the case law. Okay, and then there is one Supreme Court decision. I will come to that. But before that, there is one more exception. One more exception is not actually exception. It comes as at a later part. It says, supposing right now company has given him loan and the loan amount is deemed as dividend to the tune of, let's say, accumulated profits of 100 lakh. But later on, when company actually declares dividend, and at that time dividend, so right now 50 lakhs is deemed as dividend, company later on declares dividend and the share of this shareholder in the actual dividend is 56 lakhs. So company requested him that we will not pay you 56, we will adjust it against this earlier deemed dividend. So rather than paying 56, the actual dividend, company paid him only 6 lakhs. Then this 50 lakh should not be considered as dividend once again as a part of 56, because out of 56, which is real dividend, first 50 lakhs is already taxed as deemed dividend under 222E, should not be taxed again. That is the concept. Okay. And there is one Supreme Court decision which we will discuss. Before that, now here what happens is, it's not necessary that company should have given loan only to that shareholder. company might have given loan to third party also, or company might have made payment to third party on behalf of such shareholder, that will also be deemed as dividend. So payment made by company in which public are not substantially interested, private company, by way of advance or loan to any shareholder holding 10% or more substantial interest, or even if payment is not made to or loan is not given to shareholder, loan is given to any concern including HUF, partnership firm, LLP, in which such shareholder holds a substantial interest. Shareholder holding substantial interest means 20% or more of profit sharing rights or interest. So, company X Limited, shareholder is Mr. P, he is holding 40% shares. Company either gives loan to him, or because his shareholding is 10% or more, or company gives loan to a concern in which Mr. P holds substantial interest. Company gives loan to Mr. P HUF. Then also it will be deemed as dividend in the hands of Mr. X to the extent of accumulated profits. Okay. So any payment by closely held company on behalf of such individual HUF, on behalf of any such shareholder, shall also be deemed as dividend to the extent of accumulated profits, even if paid to third party. Okay. Now what happened is, in one of the cases, company X Limited, rather than giving loan to Mr. P who holds 40% shares, otherwise it will be deemed as dividend if loan is directly given to him. So company gave loan to Pune who holds no equity share in the company. Company gave him 80 lakh rupees of loan, and in turn, loan is passed on by Pune to shareholder holding 10% or more. He passed it on to shareholder. In such situation, this will also be deemed as dividend, directly given by company, then also deemed as dividend. If not directly given, indirectly given, routed through Pune, then also it will be deemed as dividend as per Supreme Court decision of L. Algu Sundaram Chettiar versus CIT 2001. Okay, it's a 2001 case law. Questions have already come 2-3 times. Now question no more expected, but just keep it in your mind. So if you think of working out some solution like this, tax planning, then don't do that, it will fail. Now most important part, 222 subclause F, buyback of shares. This year, 1st October 2024, Nirmala Sitharamanji deleted this chapter called buyback tax, BBT, or tax on buyback of shares. So since quite some time, since past at least 10-15 years, what was happening was, whenever a company, whether public or private, would buy back the shares, its own shares, then logically speaking, you are the shareholder, I am company, I am buying back shares from you. I should not be taxed at all. You should be taxed on capital gain arising, if at all. You should be taxed subject to indexation. However, around in AY 2010-11, Chidambaramji was a finance minister. AY 10-11, they changed the provision. Now when company buys back its shares, then company will pay buyback tax. Shareholder will be exempted under 1034A. For shareholder, no tax, whether taxable under PGBP or capital gain for shareholder, and company will be paying buyback tax at the rate of 23.886%. Now Nirmala Sitharamanji has done this. She deleted this buyback tax from company, because what was happening was, company would end up paying on an amount which is without indexation, plus company will end up paying this tax on what company is paying to the shareholder, say 1000 rupee, minus what company had received from the shareholder, 10 rupee. Huge amount was getting taxed under this, which was injustice, and that too taxable at 23.286%. Now buyback tax, 1st October 2024 onward, if the buyback takes place on or after 1st October, then it will no more be taxed in the hands of company, it will be taxed in the hands of shareholder. So on or after 1st October 2024, company buying back the shares, whether public or private, company whatever makes payment to buy back the share, entire amount will be deemed as dividend in the hands of shareholder. Up to 30th September 2024, position was this: company would pay buyback tax, shareholder would be totally be exempted. 1st October 24 onwards, company will not have to pay any tax, but shareholder will be charged to tax. and that too on the entire amount. Say company, you bought the shares for 800 rupee per share. Now company is buying back for 1200, company is paying you 1200. So technically your gain is 400 rupee per share, but nothing doing. How much you paid to acquire the shares, that is immaterial. Company is paying you 1200, entire 1200 will be deemed as dividend under 222F. 800 rupees your cost of acquisition will be allowed as a deduction as per section 46A under capital gain chapter, which we discussed already. As per 46A, sale consideration under the head capital gain will be 0 and cost of acquisition will be your 800. So 800 will be allowed as a deduction, but not against deemed dividend. It will be allowed as a deduction as a cost of acquisition under the head capital gain, which will result into long term or short term capital loss of 800, which assessee cannot set off against this 1200 deemed dividend, because capital loss can be set off only against capital gain. Long term loss can be set off against long term gain, and short term capital loss can be set off against short term capital gain or long term capital gain. You know about it. Otherwise, this will have to be carried forward if could not be set off against other capital gain. So simply, Nirmala Sitharaman ji said, you have received 1200, you had incurred 800. 800 we will allow you, but not under the IFO. Income will be taxed under IFOS as deemed dividend. Deduction would be allowed under the capital gain. Pay tax on full 1200 as per your slab rates applicable. Had this 1200 been taxed under the capital gain, then from that 1200 we could have claimed deduction of 800. Only 400 would have been taxed, and that too as at some nominal rate, 10%, 12.5%, 15%, etc. But here, as deemed dividend under 222F, it will be taxed under IFOS, that too at slab rate or whatever is a normal rate applicable to the shareholder. So, any payment 222F 1st October 24, any payment made by company, whether public or private, for purchase of its own shares, that is buyback of shares from the shareholder in accordance with section 68 of Companies Act. That means maximum 25% can be bought back in any one given year, that you know, will be deemed as dividend in the hands of shareholder. Entire amount will be deemed as dividend. In all earlier 222 ABCDE, it was to the extent of accumulated profits. Here it is not to the extent of accumulated profits. Here entire amount will be, entire 1200 in our example will be deemed as dividend without any deduction towards cost of acquisition or without any brokerage, stamp duty, nothing will be allowed. If the buyback takes place up to 30th September 24, then shareholder was totally exempt under 1034A. Company had to pay buyback tax. Now 1034A is also deleted. Also refer to section 46A of capital gain chapter, which we are done with. In any case, company will be required to deduct TDS under 194 on all the 6 types of deemed dividend as well as actual dividend. This we discussed in TDS chapter also. Refer to TDS chapter's video if you want to. Next is, so deemed dividend is over. 222F is very important. Do it thoroughly. Permissible deductions from IFOS. Here nominal expenditure, actual expenditures, real expenditures incurred to earn the income will be allowed. 57(1), which is 57 clause 1, commission remuneration paid for realizing interest on security investment. This if you don't study now, if you go without studying, then also you will be able to recollect. 57(1)(a) unimportant. This is something pertaining to what we discussed in part 1. Employer receives employee's contribution for RPF, which is deemed as income. So I am the employer. When employer contributes something, employer cannot deposit in his RPF account directly or EPF account. He has to route it through me. I paid him 30,000 salary per month. He repays me back 3,000 per month as his contribution. So that 3,000 will first of all be my income. I paid him 30. So I will get deduction of 30. Then he paid me back or refunded me back 3,000. 3,000 will be my income. And then when I pass on 3,000 to his RPF account, when I deposit it within the due date given in that act, I will get deduction of 3,000. So this will be like contra entry. However, this ideally goes under the PGBP, which we discussed in PGBP chapter as well. But when will it come here? Here it will come only if employee is not for business profession, employee is for IFOS. Same as 36(1)(5)(a) of PGBP chapter. Okay, provided it is deposited on or before the due date of such fund. Due date of such fund, which is 15th of the next month. January month contribution should be deposited by 15th February and so on. Otherwise, permanent disallowance. Okay, this structuring which I had explained to you, which I am not repeating. 57 clause 2, which is again unimportant, repairs, depreciation, insurance premium, etc. These recurring expenses on plant machinery, building, furniture, fitting, provided rental income from these assets is taxable under this head. If income is taxable under the head PGBP, then these expenditures will also go under the head PGBP. These expenditures are same as section 30 and 31 of PGBP chapter. Everything is same. Fundamental differences under which head the income is taxable. If income under PGBP, these expenditure will also be under PGBP. Income under IFOS, expenditure also under IFOS. Depreciation as per section 32 at the rates given in appendix 1 and appendix 1A to income tax rules, WDV method, same rules, 32(2) unabsorbed depreciation carry forward for unlimited period. Everything is same, just like PGBP chapter, same conditions and subject to provisions of section 38. Section 38 means if asset is partly used for IFOS income earning purpose and partly used for personal purpose, then that much part of these expenditures or that much part of depreciation which is attributable to personal use will be disallowed. 57 clause 2 is standard deduction from family pension. This we are done with. Remember, instead of 15,000, limit will be 25,000 if opting for new scheme. Whichever is less is allowed. 57 clause 3, this is same as 37(1), generally allowable other expenses if 4 conditions are satisfied. In 37(1), there were 5 conditions. Here there are 4 conditions. 2 positive, 2 negative. Number 1, the expenditure, which 2 positive condition? It should have been incurred wholly and exclusively for earning income. And last is positive condition, it should have been incurred during the previous year. So, last year's expense you claim last year, next year's expenditure you claim next year. Only if it is of current year, then only you deduct it in the current year. And these two are negative condition. It should not be, given expenditure should not be capital expenditure, should not be personal expenditure, which are easy to remember. 57 clause 4, that also we are done with, standard deduction from interest on enhanced compensation or delayed compensation, but interest. Not each and every interest, standard deduction is allowed at the rate of 50% of such interest, but not from each and every interest, only interest from enhanced compensation or delayed compensation. Balance 50% will be taxable, but 50% standard deduction is allowed subject to condition that no other expenditure will be allowed to be claimed. No actual expenditure, no legal expenditure, no stationery, stamp paper, other legal expenses, no other expenditure will be allowable. There are 4 types of standard deduction in this entire syllabus. One in IFHP chapter, one in salary chapter up to 50,000. Instead of 50,000, it will be 75,000 under new tax regime from AY 25-26 onwards. PGBP chapter, there is no standard deduction. IFHP section 24 clause A, 30% of net annual value. 57 clause 2A and 57(4), this is standard deduction from family pension up to 15 or 25,000. And standard deduction from this. 4 types of standard deduction are allowed. Okay, some places it is in percentage form, some places it is in the form of amount, and family pension is a combination of amount and percentage, 33 1/3 or 15 or 25,000, whichever is less. So, section 57 proviso, very important from exam perspective for final C. It says that while calculating dividend or income from units also some people call it as dividend from units. Simply dividend from shares or dividend from units, no deduction will be allowed for any expenditure other than interest on loan taken or capital borrowed to invest in the shares or units. No actual expenditure will be allowed to be deducted, no standard deduction, only one expenditure will be allowed, that is interest on money borrowed, and that too subject to some upper limit, not more than this much interest will be allowed. How much interest? Suppose I took loan of 1 crore and invested shares of company Reliance Industry. From the shares of Reliance Industry, I received dividend On this loan, I am paying interest. I am paying interest of, let's say, 12 lakh rupees. 12 lakh rupees. Now from the shares I received dividend, I had invested some amount of my own also and some amount by borrowed capital. Total I purchased shares worth 3 crore rupees, and from 3 crore rupee worth of shares I received dividend of let's say 18 lakhs or 24 lakhs. Let's say 24 lakh hypothetically. So this interest, you feel that the interest is less than dividend, entire interest should be allowed. Answer no, entire amount will not be allowed. Deduction will be allowed to the tune of maximum of 20% of the income. 20%. Interest, first of all, other than interest, no other deduction allowed other than interest, and interest also shall not exceed 20% of dividend amount or income from units before deducting such interest. 20, it's not saying 20% of interest. Interest amount into 20% not to be done. What is to be done is income amount into 20% will be 4,80,000. I will get deduction to the tune of 12 lakhs the actual interest or 4,80,000, whichever is lower. And 222F amendment in connection with 222F deemed dividend arising on account of buyback of shares by company. No deduction, not even interest, nothing will be allowed against deemed dividend under 222F. Other deemed dividends 222A till 222E are eligible for interest expense to the tune of 20% of income. This example, please remember, exactly same kind of question likely to come in the exam. Keep it in your mind, it will come in the form of MCQ, not a separate question. Deductions not allowed. Section 58, primarily you need to remember personal expenditure not allowed, capital expenditure not allowed. Then whatever we discussed in PGBP chapter, some of them are reproduced here. Section 40 clause A, that is payment made without TDS, 30% or 100% will be disallowed. 40A subsection 2, excessive payment to relative will be disallowed. 40A3 and 3A, cash expenditure exceeding 10,000 in one single day to one single person will be disallowed. Personal disallowed, capital expenditure was disallowed. Interest and salary paid outside India without complying with TDS provision. Outside India, then 100% will be disallowed and not 30%. Or any payment to resident in India which is liable for TDS, if tax is not deducted or deducted but not deposited, then 30% of such sum will be disallowed. This is exactly same as 40 clause A subclause 1A. Point number 2 and 3 with regards to payment outside India. Point number 4 with regards to payment due in India. Wealth tax not allowed, but wealth tax is deleted also. Disallowance under 40A and 58 subsection 4 is very important. No expenditure will be allowed as a deduction for any expenditure incurred for earning winning income. Winning from lottery, crossword puzzle, card game, winning from horse race or gambling, betting, etc. Except in case of winning from online game. Except in case of winning from online game. For online game it will be allowed. Why? Because for online game what is taxable is net income. Net winning is taxable. Okay, section 59 totally unimportant, gets over in one line, same as section 41(1) PGBP income. PGBP deemed profit, PGBP, like deduction was claimed in an earlier year and now there is a, like bad debts recovery, deduction was claimed earlier, now there is income or that amount is no more payable which was claimed as a deduction on accrual basis. Then I have list of incomes which are exempt under this chapter. This is something ordinary. Section 10(1) you quickly glance through on your own. It's just that it is not a part of this chapter, but I have covered it here. Agricultural income 10(1) you know pretty well. From agricultural land in India. 10(10)D maturity proceeds of life insurance policy. But maturity proceeds of life insurance policy including bonus is normally exempt. Life insurance policy normally exempt, but in certain situation it will not be exempt. So when will it not be exempt? If the annual premium exceeds 20% or 10% or 15% of the sum assured, depending upon the date of issue of policy, or if it is Keyman insurance policy KIP, or if it is ULIP, then it will go under the capital gain. ULIP on or after 1st February 21, unit link insurance policy. But Maturity proceeds of ULIP, whether it's a high premium ULIP, we call it as, if the premium exceeds 2,50,000, then that will go under the capital gain, will not even come here. And this is important point what we studied in the last session in the part 1, 56 subsection 2 clause 13. If the normal policy but premium exceeds 5 lakh rupees, provided policy is issued on or after 1st April 23 and the premium. So as of today, either the premium for the new policy, either premium exceeds 10% as a percentage if it exceeds 10% of sum assured, or in terms of amount if it exceeds 5 lakh rupees in a year, then it will be taxable. However, in barring KIP, Keyman Insurance Policy, in all the above situation, taxability will not arise if the policy matures because of death. Policy matures because of the death of the policyholder, except in case of KIP. KIP, whether the policyholder dies or does not die, maturity proceeds taxable. When would it be taxable under the IFOS? That also we discussed in the last session. TDS under 194 DA at the rate of 2% now or 5% earlier will be applicable if the maturity proceed is not exempt, and maturity proceeds are not exempt and under 1010D and the amount exceeds 1 lakh. Maturity proceeds is 1 lakh or more than 1 lakh. Earlier 5%, 1st October 24 onwards 2% TDS. 1011 amount received from PPF account or RPF account. 1011 is Sukanya Samriddhi deposit. Both are on the same lines. You had been depositing up till now. Now everything is received back. What you receive back may comprise of principal amount contributed by you as well as interest up till now. Both the things will be exempt. Mainly PPF. Real life, I have seen many people who know this concept, PPF withdrawal is exempt, but they don't know the clause number. They goof up. 1012, same thing for RPF account. When you are withdrawing from RPF account or employees provident fund account or statutory provident fund account, simply any provident fund, if you are withdrawing to which recognized provident fund act is applicable, then it will be exempt under this. And if PPF act is applicable, then 1011. So only PPF under 1011 or other provident fund account under 1012. 1012A and 1012A, 1012B withdrawal from NPS account. If you are closing the account, then whatever you receive, 60% will be exempt, 40% will be taxable. So you had deposited up till now 1 crore 20 lakh, including interest and principal amount. Now you are closing the NPS account, National Pension Scheme account. If you are closing the account and withdrawing, then 60% will be exempt, 60% of balance lying, that is 72 lakh will be exempt, balance will be taxable. And 12B, if you are an employee and you are making partial withdrawal from pension account, that is NPS account, you are not closing the account. If you are closing the account, then 1012A. Not closing the account, 1012B. 1012B, what will be exempt will be 25% of the amount contributed by employee himself. Now this NPS account may have 3 elements: employee's own contribution, employer's contribution, and interest on both the contribution. Here, if he closes the account, then whatever is the balance lying into 60% will be exempt, 40% will be taxable. In case he is not closing the account, there is a partial withdrawal, then exemption will be to the tune of 25% of what he had contributed till now. Okay, for example, he had contributed till now 40 lakh rupees himself, employer had contributed 40 lakh, and interest till now on accumulated balance is 40, total amount is 1 crore 20. If he closes the account, account is closed and amount is withdrawn, then 1 crore 20 lakh into 60%, 72 lakh will be exempt, balance 48 taxable. But if he is not closing his account, he is simply withdrawing partial, is making partial withdrawal, account is continued, 16 lakhs is withdrawn, then exemption will be whatever he had contributed into 25%, that is 10 lakh will be exempt. Out of 16 lakh, 10 lakh will be exempt, 6 lakhs will be taxable. And in case account is continued but 8 lakh is withdrawn as compared to 16 lakh, full 8 lakhs will be exempt to the tune of 10 lakh, restricted to 10 lakhs exempt, restricted to 8 lakh, balance 2 lakh exemption can be claimed in the future. That is 1012B. 1013 amount withdrawn from approved superannuation fund. 1015 post office savings account interest. If single account, single holder then 3,500 per annum, or if combined joint account then 7,000, okay, plus interest on deposit certificates, FD certificates under gold monetization scheme or gold bonds issued under gold monetization scheme will also be exempt. This many people are not aware of. 10.15 interest payable to non-resident by a unit in IFSC on or after on funds borrowed on or after 1st September 19. This we had already discussed in which chapter? Special rates of tax, chapter 12. 10.16 educational scholarship, whether receipt from anybody, not necessarily it should be receipt from government. My very first student who got first rank all India, she received 50 lakh rupees from some state government. She received equal amount from different politicians in their own personal capacity. Everything would be exempt if you describe it as educational scholarship. No need to actually study further to prove that it is educational scholarship. 10.17 constituency allowance, that is daily allowance of MP, MLA, MLC, but salary received by them will be taxable, daily allowance will be exempt. However, only under old scheme, only under old tax regime, not under new tax regime. 10.17 any award reward like Raman Magsaysay Award, Bharat Ratna Award, Khel Ratna Award, etc. or any other gallantry award, bravery award, these award Padma Bhushan, Khel Ratna, Bharat Ratna, Paramveer Chakra. Along with reward, government gives not only trophy, government or any shield, government will give check of 5 lakh rupees, 10 lakh rupees, 50 lakh rupees, that will also be exempt. 10.18, 10.19 are both unimportant. These are exemption available from pension. If employee is aware, if employee is a central government or state government employee and he had received Veer Chakra, Paramveer Chakra, Mahavir Chakra or such other gallantry award or bravery award, and if an employee dies, then family pension received by family member. If he is alive, then he will receive pension. If he dies, his family members will receive that pension. In either case, pension will be exempt. Salary would have been taxable, pension would fall under this head, pension will be exempt. This pension which he himself would receive would have been taxable under the salary. In salary head also it will be exempt. And if family pension is received by family members, then IFOS, again it will be exempt. 10.19 family pension received by widow, children or nominated legal heir of such an employee who was employee of central government or as a member of armed force including paramilitary forces of the union. Union means central government. He was member of armed force of union, that is of central government, and he dies during the course of his duty. Death has occurred in the course of operational duty or in the circumstances or condition as may be prescribed. Then family members receiving family pension taxable under IFOS will be exempt entirely for family members. So, two types of people. Number one, employee who had received gallantry award, his family pension, family member receiving family pension will be exempt, and here family pension received by that employee who died during the course of operational duty. Death during operational duty. Okay, here death could be in a normal circumstance, section 10.18. For 10.19, death should be during the course of operational duty, when he is on duty, war, etc. That's it. With that, income from other source revision is over. See you in the next video with some other chapter. Till then, wish you all a very good luck. All the best.